Good morning and welcome back to Morning Markets on Friday the 22nd of January. In today's session, we'll cover the key market movements over the last 24 hours and bring you up to date on the European Central Bank's meeting, which took place yesterday. Starting with a review of the markets, looking first at equities. Here in the UK, you had the FTSE 100 off 0.4%, the FTSE 250 off similar levels, but the small cap index demonstrating relative resilience off just 0.01%, maintaining gains year to date of 3.5%. In Europe, we had the Euro Stoxx 50 index off very marginally, much like the UK. This follows a positive trading session on Wednesday, where the index posted gains of positive 0.8%. The index continues to hold positive returns year to date, up 1.9%. Broader baskets encompassing a greater exposure to mid-cap and small-cap names more resilient, closing up 0.01% on the day. And on a sector basis, a strong day for technology relative to the more economically sensitive areas of the market. Across in the US, the S&P 500 in the green at close, up 3 basis points. The technology-focused Nasdaq Composite showing resilience, up 55 basis points on the day. In Asia, the Shanghai Composite came in 0.4% overnight, retreating from the 5-year high, which was hit in the previous session, closing 1.1% higher for the week. In Japan, the Nikkei was off 0.4% and the Hang Seng down around 1.6% as concerns over the increase in new infection rates and US-China tech relations come back to the focus. In currency markets, a degree of US dollar weakness on a trade-weighted basis when compared to a basket of developed market currencies. Buying for sterling strengthened against the US dollar yesterday from 1.36 to 1.37. And relative to the euro, a bit of movement around lunchtime. That was around the time of the European Central Bank meeting. The rate moving from 1.12 to 1.13, but paring back, i.e. we had some euro strengthening in the later trading session, so that paired back to around 1.129. In bond markets, in the UK, you had the yield on 10 and 30-year government bonds move out some 3 basis points higher, taking the current yield offered to 0.32% and 0.91%. In the US, on the 10 and the 30-year Treasury bonds, the yield moved out 2.5 basis points to 4 basis points across the piece. The differential in moves across the 10 and the 30-year leading to a steeper yield curve. For some more information around that, please do see the Morning Markets video from Thursday. The moves take current yield levels to 1.1% and 1.87% as momentum builds around the Democratic fiscal stimulus package. The need for additional support was subtly drawn out in the data from the jobs market yesterday, highlighting very little change in the number of people claiming initial unemployment support. The headline number was down around 26,000 people on the week, which in the grand scheme of things is around 2%. There was similar level of change in those claiming on a continuing support basis. The package now supports some 5.3 million US citizens. Movements in the European bond market continue to provide fascinating insight into the expectations of market participants for how the region will manage debt levels, economic growth and inflation. The more pronounced moves yesterday were within Italy, where bond yields on a 10 and a 30-year maturity pushed out 6.7 and 7.3 basis points, taking levels to 0.68% and 1.55%. A few factors driving Italian yields over the week, one being anticipation of greater bond issuance to finance increased government spending plans, which were agreed on Wednesday, which is negative for prices. So due to the inverse relationship, a fall in prices leads to a higher yield level. A second being comments from the ECB yesterday, leading market participants to anticipate the purchase of Italian debt. Therefore, the demand for Italian debt from the ECB may not be as significant as initially expected. But that in itself offers a nice segue into the discussion from the key takeaways from yesterday's European Central Bank meeting. A focal point of the meeting was around economic growth expectations, so no surprise there. There was a cautious tone set for the first quarter of 2021, given the imposition of tighter restrictions on activity. However, Christine Lagarde did highlight those economic risks are now less pronounced, citing the support offered by the vaccine rollout. In the meeting, the Governing Council reconfirmed its accommodative monetary policy stance. The interest rate on main refinancing operations, so marginal lending facilities, is to remain unchanged at 0% and 0.25%, and the headline number, so the key deposit facility, also to remain at negative 0.5%. Rates are expected to remain at this level until inflation readings move to a level viewed as sustainable, but also around target of 2%. On an aggregate level, the Governing Council will continue the purchase of government and public bonds under the Pandemic Emergency Purchase Programme, so the PEPP or the PEP, with a total purse of €1.85 trillion. Now, remember, this includes the €500 billion increase which was agreed in December. Purchases under the PEP will run until at least the end of March 2022 to preserve favourable financial conditions. The market has gone back asking for a bit more detail on the definition there. However, realistically, this will be until the Governing Council judge that the coronavirus crisis phase is over. There were some interesting, though perhaps not surprising, comments around the PEP given the increase in the package last month, with the ECB on one hand highlighting they do not expect to exhaust the envelope, but reassuringly for markets are willing and able to recalibrate if required to continue the support. So looking at Bloomberg surveys there this morning, expectations are from around 91% of respondents is they anticipate the current purse is sufficient. Finally, the longest standing asset purchase program, which has been in the background for a number of years but was really dialed back up in 2019, will continue. Therefore, they'll continue with the purchase of bonds to maintain favourable interest rates at a monthly rate of €20 billion a month. And that will run for as long as necessary to reinforce accommodative policy rates, supportive lending conditions, and continue to reinvest the principal from maturing bonds for as long as necessary, even beyond the point of raising rates to maintain those supportive liquidity conditions, i.e. access to finance. So headlines of the day very much focused on COVID developments, progress in the White House and economic growth in Europe, but within the detail, evidence that the central bank remains very supportive. I'll leave it there for today. I hope you have a great weekend and the team look forward to bringing you up to date on Monday morning. Thank you.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.